Okay. Good morning. Also, you can get directly in. I'm just addressing the chat room. The flashlight's down, just so you know, in any of your classes, you can access Blackboard without going into Flashline. It's the way I always access it anyway, but you do learn.kent.edu. That will get you directly into Blackboard. Also, the URLs we have for the class, the tiny.cc class 001 and class 002, also get you directly in Blackboard and avoiding Flashline. So Flashline right now is down, but Blackboard is up and running, and I just put up an auto reply, so if anyone emails me, they get that information. So we are going to get started with class. We do have a Learning Catalytics question out there, and so we will start with the Accounting Association. I think anyone's here for it. Okay. Accounting Association is the organization for accounting majors. If you're an accounting major or thinking of becoming an accounting major, this is an excellent group to join. It has meetings. They have meetings every Wednesday from 5:15 to 6:30 in this room, actually. And if you want additional information, send me an email and I'll connect you with the people you need to talk to. So that said, now one more accounting major announcement. You might have gotten it, well, you did get an email from me about this. If you're an accounting major, and everybody else, just sit tight, but if you're an accounting major, this is the one event, I would say, if you only do one thing this semester in terms of an activity for accounting, if you're an accounting major, this would be it. This is big, big, big. This is Meet the Accountants Night. It is this Thursday night. It is from 5:30 to 8. It is in the Student Center Ballroom. What we do in this event is we have over 40 employers come in, and it is accounting employers. They come in and they all have booths. And then students come in and walk around and talk to the representatives. Most of the firms have recent Kent alums come staff the booths. So you'll be talking to people who graduated from Kent within the last few years typically. We have all the major public accounting firms there. We have firms like Smucker's there, Joanne Fabrics. We have the auditor of the state of Ohio. So there's all these firms, and then students come and talk. Now, our accounting majors that are a year ahead of where you are right now, if you're an accounting major, a year from now, you will be doing this event. You'll be dressed professionally with resumes, circulating, talking to firms, and internship interviews start right after this. So what this opportunity this year for you is to go see what it's about. You do not want to go to Meet the Accountants Night next year for the first time. So if you were in an accounting FYE class last year, you were required to go, but there's a lot of people who didn't take an accounting FYE class. They had a more general class. So this event, for you to get to go this year when it doesn't quote-unquote count, it's excellent. You do need to dress business casual or professional attire. The more professional you can look, the better. This is one of those events. You cannot show up in shorts. You cannot show up in flip-flops. You will be turned away at the door if you're in jeans or yoga pants or things that are not professional. If you have any questions at all about how you should dress, please contact me ahead because they will not let you in the door if you're not appropriately dressed. But you get the opportunity, so let's say you dress up nicely. You can bring a resume. If you don't have a resume yet, I would not let that stop me from going, but you come in the door and then you circulate and you talk to employers. Now, when you go up to a booth, you have a couple people standing there. Most of these people are not scary. I know this is makes a lot of people nervous to do this, and I totally get that. But you go up, you shake their hand, and you can tell them you're a sophomore accounting major. If you're really nervous about this, please know that I am there at that event from 5:30 to 8. My whole reason to be there is to talk to students and to help connect you with firms. So if you show up, especially being a sophomore, you just find me. I'm typically near the door around there. You just find me. Tell me you're in my class, because sometimes I can't place where I know you from. Tell me you're in my class, and then I will help introduce you to someone and get you started. But this is a wonderful opportunity. If you have a resume to bring, absolutely bring it. I would not let that stop me, though, from going. It's Monday. This event is Thursday. If you don't have a resume, it might be a little late to scramble. You don't want to give out a terrible resume, because that's worse than no resume at all at this point. But you go to this event, get as many business cards as you can, talk to people, connect with them, and then follow up after the event. Connect with them on LinkedIn. If you don't have a LinkedIn profile, that's another thing you need to get going with. I would invite you, too, to connect with me on LinkedIn. Anyways, if you have questions, let me know. I don't want to spend any more time on it. But again, if you are an accounting major or even thinking about it, this is the one event this year. If you only do one thing this semester, this would be it. This event is only offered once a year. So you don't have an opportunity in the spring to do it. It is right now. It's Thursday from 5:30 to 8. You do not need to be there from 5:30 to 8. You can show up at 6 o'clock. You could show up at 6:30, and typically you could spend certainly more than 15 minutes. You could spend as much or as little time as you want. I would not show up right at 8 o'clock, because firms start closing up around 7:30, but they're still there till 8. So it's not like you have to be there right at 5:30, but I would absolutely go if I were a sophomore accounting major. And I know you have a lot of competing demands on your time, but this event is very much worth it. And absolutely come and talk to me at the event. But this is the best event as a sophomore that you can do. Any questions? Okay. There's food at the event, too. So off to the side, after you talk to firms, there's tables of food and soda pop and water and stuff. So that's there, too. Okay. This week, we have Chapter 2 homework. Heads up, this week, heavy lifting this week. This week's homework is going to take you more time. Last week, yes, fundamental chapter, gave you introduction to the statements. Chapter 2 and Chapter 3. So this week and next week are the most fundamental chapters for the rest of the course. Okay? If you don't get these chapters, the rest of the course is going to be extremely hard. We don't have a cumulative final in this class, and the exams aren't cumulative, except Chapter 2 and 3 content shows up just organically in everything we do the rest of the semester. Chapter 2 homework going to take you a lot longer than last week, and that's by design. This is a really important chapter. This chapter and Chapter 3, wow, they're huge, okay? And so you need to put the time into it, but more importantly, you need to get that practice to be understanding it. So Chapter 2 homework due this weekend. We do have a question in Learning Catalytics. If equity is $3,500 and assets are $5,700, how much is total debt? And total debt is the same as liabilities. Don't use dollar signs or commas in Learning Catalytics. So what we're going to, let me see where. Okay. On this, okay, so we have a bunch of responses. So on this one, I see a lot of people have the right answer. So on this one, the question's still open, but I'm going to go through the right answer so you can make sure you have the right answer. I'm not going to close it for a minute or two. So if equity is $3,500 and assets are $5,700, how much is total debt? Total debt is the same thing as total liabilities. So we have assets equal liabilities plus equity. So we fill in the things we know. We know assets are $5,700, equity is $3,500. We can then subtract the $3,500 from the $5,700. and we end up with equity of 2,200. Okay, so that accounting equation, that's the big takeaway from Chapter 1, among other things. But the accounting equation, you need to be able to manipulate it to solve for something you're not given. So that's 2,200. I am not closing the Learning Catalytics question for another minute or so. So you're not going to see it close on your device quite yet. Make sure you enter it if you've not done that yet. But we are going to start the content, and the question will get closed in the next minute or so. I'm not going to announce before it closes. So if you don't have it answered, you want to make sure you get it answered. Yes. I'm sorry, what? Okay, okay. Yeah, today, Amir wanted me to tell you, we're doing participation grading today. Today is the last day that it will be participation-based. Starting Wednesday, it's going to be 50% accuracy and 50% participation, but today is still 100% participation, okay? But today, I'm running it exactly like it's going to be Wednesday in terms of, as you can see, this first question, if I may or may not go over the answer before I should close it. Usually the first question of the day, I'm going to give you the answer before I close it, but know that starting Wednesday, your accuracy does count. Okay, so Chapter 2, transactions. If you had accounting in high school, a lot of this is going to be reviewed for you. And I'd say Chapter 2 and to some extent Chapter 3 are accounting in high school. And after that, your advantage will erode. But if you've had accounting in high school, Chapter 2 and 3 are going to feel a little more comfortable for you. Everyone else, just know that if you've not had accounting before, we're going to be talking, we're getting very quickly into debits and credits and this whole accounting lingo. It's going to feel like a foreign language. It's going to feel very uncomfortable, and I'm going to give you some rules, and sometimes I'm going to tell you on those rules that they will make sense after you practice it for a while and look at it, and that might not happen this month, but I will tell you what you need to know, I will tell you how to do it, and you'll just have to rely on that for a while until it kind of falls into place, because there's lots of pieces of this. So, first thing, we're going to start about talking, in this chapter we're talking about how to basically analyze a transaction and how to record a transaction. So we're not trying to be bookkeepers, but we need to understand when we have a transaction in a business, how does it impact that business? What's affected? And so we start by talking about what a transaction is. Okay? A transaction is something that has a financial impact on the business right now. Okay? So it has a financial impact. It can be measured reliably. So we know we have a dollar amount associated with it. We know it's something given and something received. From an accounting standpoint, we have two sides. We record two transactions. There's two sides to every transaction. Okay? So every transaction is going to have two sides. Kind of what you give up and what you get, sort of. Okay? So we have transactions, something given, something received. I'm going to go through some examples here on the next slide. By the way, if you download the slides from today for Chapter 2, I think it's a really good idea. There are several slides that I'm going to appear to skip, but it's only because I don't want to read the slides. So when I talk about, for example, assets, I'm going to be talking about a lot of different assets. If you download the slides, there's a lot more detail on each of those assets. So when I skip slides, I'm not saying they're not important. It's just that I don't put slides up and read them. So I'm putting up the high points, and then certainly you can look at Blackboard and download the slides with more detail. Okay, so we have a transaction has a financial impact on the business. So let's look at Whole Foods. Whole Foods has lots of different transactions that they can encounter. First of all, if they purchase fresh produce, they go to get produce, they give money and they get produce, so that's a transaction. They can sell product. So you go in Whole Foods, you give them money, they give you the product, there's the give and the take. They can borrow money. They can go to the bank or issue stock, and they're giving up stock and they're getting money. They're signing their IOU and getting money at the bank. Or they can repay a loan where they give money to pay off a loan and then they reduce what they owe. Did you have your hand up? Or you were starting? Okay. So we have lots of different transactions. Now, every transaction has two sides, and that's key. Everything we do in here, we have two sides to a transaction. We will be giving up something and getting something, and that's kind of loose depending on what the transaction is. We have to record both sides. I don't think we're going to be talking about debits and credits today, but something will increase, something will decrease. We'll see that as we go. And there has to be a financial impact. So just signing a contract, no money changes hands, we just sign a contract or we agree to do business with someone, that's not a transaction. What a transaction is there's a dollar impact involved, there's a dollar amount involved, and it has happened. So it's not, we're going to sell you something next year. A transaction has not occurred. So let's try this one. Okay, so we have a question, and again, remember the question numbers don't mean anything. Okay, so which of the following business events would not be recorded in a company accounting records? The company paid a monthly utility bill. The company issued 100 shares of common stock. The company purchased 2 acres of land for a future plant expansion, and the company signed a contract to provide services in the next accounting period. Okay. So each of those items, so let's walk through those as we go forward. The company paid a monthly utility bill. There's a dollar amount involved there, and something did happen. We paid a monthly. That's a transaction. So it won't be A, because we paid this utility bill, and there's a dollar amount. Even though we're not given the dollar amount, there is a dollar amount involved. B, the company issued 100 shares of common stock. If the company issued stock, that means they're saying, here's our stock certificate, and an individual or company is giving them a set amount of cash, a certain amount of cash. So B is also a transaction because there's a dollar amount involved and it can be measured. C, the company purchased 2 acres of land for a future plant expansion. Okay, so the company went out and paid cash and got the deed for the land. Okay, that's a transaction. There's a dollar amount involved. Now, and it happened. Okay. Now, D, the company signed a contract to provide services in the next accounting period. Okay, the company signed a contract. No money has exchanged hands. We just signed a contract. That could be a huge event, but it's not a financial transaction. Nothing has happened that no money has exchanged hands. There is not a, it's in the future, and it has not happened, so that is considered not to be a transaction. So the answer here is the company signed a contract. That is not considered a transaction. Okay, so that's the first learning objective in the chapter, is being able to identify a transaction. So we have things that happen that are not transactions. We're not saying they're not important, but they're not recorded. Okay. So next up, what we're going to do is we're going to start talking about accounts. We are going to, on Wednesday, get to debits and credits and all that kind of thing, but we have to talk about accounts. And we talked about this some in the last 2 weeks, but accounts are these ways to keep track of a certain category of things. So an account is a record of all changes in a particular asset, liability, or stockholders' equity during a period. So it's considered to be, I guess when you look at the definition of an account, it's considered to be summary, a basic summary device. It's basically, here's my cash account. Here's all the transactions that impacted cash. How much do I have? I'll look at that account. I'll have an account for land. I'll have an account for accounts receivable. I'll have an account for the loan I have payable at the bank. I have common stock account. So we have accounts, and so we'll have assets, we'll have liabilities, and we'll have stockholders' equity. Okay. Now, again, if you have the downloaded PowerPoints, you'll see there's several slides coming up here that talk about the different kinds of accounts. And what I'm going to do is I'm going to talk about assets in general. So I'm going to spend actually quite a bit of time on this slide, but the slides that we just skipped are absolutely relevant, and you're going to hear some of that as we go through these. So, assets. So we're going to talk about different kinds of accounts today. We're going to use some of these accounts when we start recording transactions. So the first one is cash. And cash, I think, is the most intuitive account. We can recognize this is how much cash we have. Now, cash can be coins, it can be dollar bills, but it can also be checking account, savings account, things that are near cash. So we have cash and cash equivalents, but we always just refer to it as cash. So cash is an asset, okay? Next down, accounts receivable. Accounts receivable are amounts, and I'm going to pretend I'm the company. So when I talk about do us, I'm talking about I'm the company, I'm the corporation. If I have accounts receivable, that means individuals or other companies owe me money, okay? This is, if I'm a doctor, and I have accounts receivable, these are the patients that owe me. They've already come in, they've had their visit, and they didn't pay at the time of service, okay? And so if you go to the doctor and you don't pay, they actually have an accounts receivable. So that's an amount due from you or from your insurance company, but accounts receivable are amounts that are due the company. So I'm the company, accounts receivable are amounts due me. Okay. Notes receivable. This is where I've made, as a company, I've made a loan to maybe a customer. They've signed a note, a formal note. So a formal note, we have a loan agreement, you pay interest on it. When I worked at Plastic Lumber, one of the things I did is I bought forklifts occasionally. And when we would buy a forklift, we would go to the company that we buy a forklift for, and then we would sign a note because we were a startup, so we didn't have a lot of cash. So we would sign a note with the forklift company, and so we were borrowing money from the forklift company, but the forklift company would sell us the forklift, we would sign this note, and the forklift company had a note receivable from us because we owed them the money. So a note receivable is amounts due the company from others that you actually have interest on it. Accounts receivable typically doesn't have interest. It's typically a 30-day thing where you have 30 days to pay or something like that. Note receivable, very similar, except it's formal. You signed a formal note, there's interest, there's terms, so that's notes receivable. Okay, the prepaid expenses. So prepaid expenses are an asset. And these are things that we bought, that we've paid for, that are going to impact more than today. They don't go away right away. So let's talk about the first one. If you get insurance from Progressive, car insurance from Progressive, and companies buy car insurance, but if you buy car insurance from Progressive, they will give you a pretty hefty discount if you pay for a year in advance. Okay, so they'll give you 10% off if you pay right now for the whole year. And that's called prepaid insurance for companies. Because what they'll do, let's say their insurance is $1,200 for the year. So they will pay, and if they pay right now, they'd get $120 off. So then they would, that $980 they would pay today, and that's then what they pay for the whole year. Now that's not insurance expense, that's an asset because that gives them future economic benefit. There is an economic benefit from insurance. You're protected from loss for each of those months that covers. So when you pay for insurance a year in advance, it goes into an account called prepaid insurance. Same thing, if we go out and we buy 100 reams of copy paper, and that's 6 months worth of paper for us, the day we buy it, we don't have office supplies expense because we're not using that paper up. We're going to use it over the next 6 months. So when we buy it, it's called prepaid supplies or prepaid office supplies. You can have prepaid rent. Sometimes corporations will pay their rent a year in advance and they get a discount for doing so. So they'll pay the rent a year in advance. So they have prepaid rent. And when you see prepaid rent or prepaid insurance, that is considered to be an asset because it has future benefit. We'll talk in Chapter 3 about what happens as the year goes by and you use that up. But for this chapter, we're talking about when we buy, say, for example, a year's worth of rent in advance, and we pay for that, that is an asset to us because we have economic benefit, future economic benefit. Okay, prepaid expenses. So you have things like prepaid rent, prepaid insurance. You have an account called supplies or office supplies, and that's we don't call it prepaid supplies. We just call it supplies or office supplies, and so that's also one. Next one down, inventory. Inventory is things that we have purchased or constructed to offer for sale. So if we're JCPenney, we're going out and buying shirts that were in offer for sale, that's inventory. So we purchase the shirts that have future economic benefit because we're going to offer it for sale. People will buy it from us. Okay, then we have land. Land is next up. Land is, as it says, we buy land that has future economic benefit for us, either to use it for some purpose or hold it and resell later, but it is an asset. Buildings, we can own them, we can use them, we can have stores in them, we can have office supplies in them, etc. We can have equipment, so this is where we have the forklift, or we have the extruders, or the drill presses, or whatever equipment we have, computer equipment. Furniture and fixtures. Retail stores have lots and lots of money invested in racks and display systems. Those are assets, as are desks, things that have future economic benefit to us. And then we have a whole slew of other assets that we'll get to in the future. Just in terms of looking at this list, on the left-hand side, those are all referred to as current assets. We talked last week briefly about it. Current assets are things that are going to be used up or turned into cash in the next 12 months, basically. So current assets, and our investors look at that because they want to see how much in resources we have to pay current liabilities. So they kind of offset current assets with current liabilities. So the left-hand side tend to be current assets, our current assets typically, and then on the right are long-term assets. Okay, so we have assets. So assets are things we own that have future economic benefit. For your purposes, you're going to have to be able to identify assets, identify liabilities, and then identify equity. So we're going to spend more time on this. So next up, we have this category of liabilities. Okay, so liabilities. Starting with on the left-hand side are current liabilities. And again, current liabilities are things that are going to come due within the next 12 months, basically. Whenever you see a definition of current assets or current liabilities, they will say something about due within the next 12 months or operating cycle, whichever shorter. Operating cycle is how long it takes our business to convert things into assets and sell them. It's an operating cycle. In this level of class, that will always be 12 months for us. So when you see or operating cycle, just know we're doing 12 months, okay? So 12 months is most common. So liabilities, left-hand side up here are, and that's just how I listed them. The left-hand side are the current liabilities, and then on the right side are long-term. So let's start at the top. Accounts payable. Accounts payable is a liability. It says payable. That means we, this company, owes money to someone else. So accounts payable, we went out and bought copy paper from OfficeMax and they gave us the invoice and we'll pay in 30 days. That's accounts payable. We have an obligation to pay this bill within the terms. When we use electricity as a business, we're using electricity, we're not paying for that electricity until the end of the period, the end of the month, because the electric company doesn't know how much we're going to use, so we have an account payable for electricity. We can also have wages payable. If you work at a company and you get paid 2 weeks after you finish, your payroll period lags. You know how when you start work, you may have to work for 3 or 4 weeks before you get a paycheck. Your company has wages payable representing amounts they owe have not yet paid to employees. Okay, and that's salaries payable. So we have the payable accounts, which we have a debt we owe. And then we have accrued liabilities. Accrued liabilities are like accrued taxes. We know, this is a good one, we know at the end of the year we're going to owe taxes, but they're not due for 3 months, so we're not going to pay them yet. We would have accrued taxes payable. It's not due yet, but we know we owe it. We owe it based on activity last year, so it's going to be accrued taxes payable. So when you see the word accrued liability or accrued something payable, that's a liability. And don't worry too much about what the word accrued means right now, but an accrued payable or accrued liability is a liability. Short-term notes payable, that's where we've gone to the bank maybe and signed a note and they've given us cash, they have our signature, we have to pay them interest and principal at some point. At Plastic Lumber, when I signed the note for the forklift, we had a short-term note payable because we had to pay it back within a year. And then the current portion of long-term debt. As a company, if you go take a 30-year loan on something, that's a long-term loan. But there's a certain amount that you have to pay in the next year. You make payments. So the current portion, the stuff that's due in the next 12 months, is reclassified as current liabilities. Because remember, we're splitting off current assets and current liabilities off into those two pieces so that our investors, when they look at us, they can say, here's how much they're going to have to pay in the next 12 months, and here's the resources or the assets they have to do it with. So what investors are looking at to make sure that you have the resources to pay what you owe. Okay, so that's on the left side. Those are liabilities. On the right side, and this is just because of how I split it out on the PowerPoint. There's not any magic at this point to left and right. It's just the way they're listed. Mortgage payable, businesses can take out mortgages on buildings as well on real estate. Businesses can take out long-term notes payable. They can get a long-term note from the bank and sign it. And then down there is unearned revenue. Unearned revenue is probably the biggest misleading name of an account. Unearned revenue is a liability. Absolutely, I will trip several of you up, and not intentionally either. You see unearned revenue, that is absolutely a liability. That's going to be something you have to make a note of because it looks like it shouldn't be a liability. Unearned revenue is when a customer has paid you in advance. Okay? When I subscribe to the Record Courier, okay, and my bill just came due. And the Record Courier, I think it's something like $100 for a year. And I'll pay the $100 to Record Courier right now. Let's say $120 because the math's easier. So $120 for the upcoming year. I'm paying the Record Courier as an individual. I'm paying the Record Courier for a year's worth of newspaper service. Now, the Record Courier has not done anything to earn that revenue. So when I send my check in to the Record Courier The Record Courier, so think of the Record Courier now as the company. The Record Courier gets my check. The Record Courier has cash. And we say every transaction has two sides. So the Record Courier has cash, that's one piece of it. But the other piece of it is the Record Courier has a liability to deliver my newspaper for the next year. They have a liability to provide me a newspaper. That's what I'm paying. And so that $120 they get from me is not revenue to them when I pay it. It is called unearned revenue. It's a liability to them. They have a legal obligation to provide the newspaper for me for a year or refund my money. So they're not going to, so when they get money in advance, it's called unearned revenue. Unearned revenue is a liability. You see the words unearned revenue, boom, that is a liability. It's one of the only liabilities that doesn't say payable or liability in it, okay? It says unearned revenue. It's money that a business has collected in advance for services or goods it's going to deliver. It cannot claim that. A huge unearned revenue account for companies, gift cards. When you buy a gift card from a company, that goes into unearned revenue. That is a liability. The company has a liability to provide you the merchandise or service when you use that gift card. Until you use that gift card, that is unearned revenue for that company. They do not record it as revenue. Okay, now, equity. So now we have the equity accounts. Now there's two main pieces of equity, and they're at the top of the screen here. The first one is stock, common stock specifically. Remember, we're talking about corporations. So every corporation has to have something called common stock. Common stock is the term. We're not using the word common as frequent or something like that. It is the term common stock. Every company that has stock has common stock. There are other types of stock. There's preferred stock, but very few companies have that. So right now, we're just going to say common stock because everyone has common stock if they're a corporation. And common stock is what investors have invested in you. So they come to you, you give them stock, they give you cash, they're investing, they're hoping to make money. Your stock price either going up or you're paying dividends, but they're hoping to make money from this. So that's common stock when you issue stock. When we talk about equity and we see common stock, it's our own stock that we're talking about. Retained earnings. Retained earnings is not like a checking account or anything. It's an accumulation of all our earnings to date less any dividends we've declared. So retained earnings over all our history is going to be increased by revenues, decreased by expenses, and decreased by dividends declared. Okay. Dividends. A company board of directors can decide to reward its shareholders by declaring a dividend. And one frequent way that they can do it is to declare a cash dividend. So what they'll do is they'll say, we're going to declare a 25-cent dividend, and that means that for every share of stock you own as a shareholder, you get 25 cents for each share. That's a dividend, and it represents a return of capital to shareholders. The board of directors declares it, and then the company will pay it at a later date. At the date of declaration, then we have a reduction of, it reduces retained earnings. So trust me on that. That's a little fuzzy at this point. We're going to get deeper into it in a later chapter. But retained earnings, it's increased by revenues, decreased by expenses, and decreased by dividends declared. So we are going to do a few questions. So these are ones kind of to try out identifying types of accounts. Okay, so first question up. which of the following is a liability account? So being able to identify a liability account. So which of the following is a liability account? We have retained earnings, accrued liabilities, accounts receivable, and prepaid expenses. I'm going to close this in about 10 seconds, so get your answer in. Again, today is participation. Last day of participation. After today, it is 50% accuracy and 50% participation. Okay, so when we look through these accounts, retained earnings is considered an equity account. Accrued liabilities, that kind of gave it away. It had liability in the title. Accounts receivable is an asset. Accounts receivable is an amount due to the corporation from others, so it's an asset. And prepaid expenses are things that, that we've paid in advance that we have future economic benefit from. Okay, next one. Okay, goods purchased on account for future use in the business, such as store supplies, are called what? And yeah, just a reminder that you want to answer the questions in Learning Catalytics. Okay, so make sure you're logged into Learning Catalytics and answering the questions. Goods purchased on account for future use in the business, such as store supplies, are called what? Today, participation, so you want to get an answer in. I'm going to close this probably in about 10 seconds. So if you don't know it immediately, this is the time to guess and get some credit. Okay. Goods purchased on account for future use in the business. Let's talk about the answers that are not right, because that's just as important as the important answer, the right answer. Accrued liabilities. Accrued liabilities are things that we know we owe but haven't gotten the bill yet, like accrued taxes. We know we're going to have to pay the taxes, we just don't have the bill yet. So that's an accrued liability. Accrued liability is a debt owed to others. When we purchase these goods for use in the store, these store supplies, let's say we purchase $2,000 worth of paper cups for use in our business. Store supplies, those are prepaid expenses, because we're not going to use them all today. We're not using $2,000 worth of paper cups today, but we're going to use them over time. They're an asset. They have future economic benefit to us. So it's not a liability. B, expenses. We're talking about something that we'll use in the future. It's not an expense until we use it up. So it's not expense. Revenue is okay. Revenue is not goods that we purchased on account. So know that if we're going to use it, future use in the business, that's not an expense today. Okay? Stuff that we buy on account for future use, those are prepaid expenses. Okay, I think I have one or two more, so we'll do the next one. All the following accounts would be considered assets except what? Okay, all the following accounts would be considered assets except for what? About 10 seconds left. Give it a guess if you don't know at this point. Okay, now what we see, cash is an asset. Okay, Prepaid expenses are assets. This is where I've paid my rent a year in advance. We can have prepaid rent. That's an asset to me. It has future economic benefit. I can have prepaid insurance. Notes receivable. This is a loan I've made to someone else. They owe me cash. That's considered to be an asset. Retained earnings is an equity account. Okay, it's just one of the equity accounts. And then I have one more right now, and then we'll go on. Okay, any event that has a financial impact on the business and can be measured reliably is what? Okay, but 10 seconds left. Any event that has a financial impact on the business and can be measured reliably is a what? That is a transaction. Okay, so those are just kind of the basic practice on identifying accounts, which type of accounts they are. We're going to see a lot more of that. I would carefully read that section in my textbook. I do have PowerPoints that give a little more detail or have a lot of what I just said in the PowerPoint, so you can download those as well. We're going on to the next one, which is looking at transactions. We're getting very close to recording transactions, but not there yet. We're going to look at a series of transactions and see how each transaction impacts the accounting equation. So what I'm going to do is I'm going to do this by example. So instead of saying here's the rules, I'm just going to walk through what happens here. So in this, if you're writing it down on paper, you need a wide piece of paper, okay? And we have a doctor that opened a medical practice in February, okay? So the medical practice is the corporation. We are recording everything from the corporation standpoint, and we're going to have a series of transactions. So this is where I said you need a wide piece of paper. You will have, imagine, lots of lines, but column-wise, you're going to have assets equals liabilities and stockholders' equity, because we're analyzing the impact of each of these transactions on the accounting equation. So the accounting equation is assets equals liabilities. Okay. So the accounting equation is assets equal liabilities plus stockholders' equity. So we have that at the top of our screen. Now, particular assets that we're going to be looking at are cash, accounts receivable, medical supplies, and land. So we have 4 assets that they're giving us. And then we have 2 liabilities. So liabilities are accounts payable and notes payable. And then stockholders' equity, we have common stock and retained earnings. So those accounts I am just giving to you. Okay, we're setting up the problem, and we're looking at, do we have to have this form? No, this is not a formal form, but this is just saying, here's our assets, here's our liabilities, here's our equity. Very simple example. Let's go through some transactions and show how they have impact on those accounts. So, and you're going to see those accounts as we go forward. Okay, so we've got assets equal liabilities plus equity. We're going to have a series of transactions. Okay, so the first one, written at the top of the screen, Dr. Luke invested $100,000 in the business in return for common stock. So we are recording this from the corporation standpoint, not Dr. Luke. These are 2 separate entities. So we are doing this from the business standpoint. So from the business standpoint, A transaction occurred. There is a dollar amount involved. It's a financial transaction, and it can be reliably measured. We know he gave $100,000. So $100,000. So first thing, the business is getting $100,000 cash. So that's one side of it. So that's what the business is getting. What is the business giving up? It's giving up common stock. So when we record this, what happens, the impact on the accounting equation is cash will go up by $100,000 and common stock will go up by $100,000. Now, if I were to do the accounting equation for Dr. Luke's business right now, the corporation, we would have assets of $100,000 equal liabilities of 0 plus common stock of $100,000. So we are in balance. Okay? Now, so that's one thing. We've gotten stock. We've issued stock in return for cash that we've gotten. Okay, so that's transaction 1. Transaction 2, the business borrows $50,000, signing a note payable to the bank. So what's going on here? So this is another transaction. It's a financial transaction, and it can be reliably measured. $50,000 note payable. So what's going on here? The business borrowed $50,000. So cash is going up by $50,000. And the other side of this transaction, so the business got $50,000. What did they give up? Well, they gave up their signature on a loan. So what happens here is we're going to have cash go up by $50,000, and we're going to have liabilities go up by $50,000. Next up, on February 8th, the business paid cash for land costing $105,000. Okay? So we have a transaction. We have the $105,000. There is a transaction there. So what the business paid cash. So what we've got here is cash decreased by $105,000. The business paid up. So the business gave up $105,000. And what else happened? Well, the business got land. So this is a case where assets, we have cash went down and land went up. So what we're going to see here is cash going down. And again, this isn't a form I'm filling out so much as just a way to keep track of the impact on assets, liabilities, and equity. So cash went down and land went up. So as a net effect, this transaction had a net effect of 0 on assets, on total assets, because one asset went down and one went up. Okay. Okay, so that next. Okay, next February 11th, the business purchased medical supplies for $1,700 on account. Okay, we've got a couple things going on here. We purchased medical supplies for $1,700. There is a transaction here. There's $1,700. There's something changing hands. This is a transaction, so we know that. So what did we get? The business got medical supplies. So that's an asset, and we had set up a column for medical supplies. So that asset is going up by $1,700. Now, the other part of this, a little trickier, what did they give up? Well, they didn't pay for it. We have the two words called on account. You'll see those over and over. This is important to know. When you see on account means it's going to be either accounts payable or accounts receivable. It means that they didn't pay cash or they didn't get cash. We can use it in a couple different contexts. We can use it when we're dealing with our vendors. We can use it when we're dealing with our customers. So this is dealing with a vendor. So this business purchased medical supplies, an asset. So assets went up. What did they give up? They now have a liability. right? Because they got the medical supplies, they haven't paid. On account says an IOU, okay? They did, it was kind of like a loan, so they'll owe it later. So in this case, we're going to have medical supplies and assets go up, and we're going to have accounts payable go up as well, because now this business has a liability for $1,700. It got the supplies, and now it has a liability because that's how it financed that purchase. Okay, next up, February 12th, the Dr. Luke officially opened for business. Okay, officially opened for business. That is a significant event. It is recorded somewhere in the corporation's history. However, that is not a transaction. There's no dollar amount that can be reliably measured there, so that's not a transaction, so it is not recorded. There's no entry for that. We only record financial transactions, transactions that happen that have a financial impact and can be reliably measured. Opening for business, while important, is not a financial transaction. Okay, on February 14th, Dr. Luke treated patients and earned service revenue of $5,600, receiving cash for half the revenue earned. Okay, so we've got a couple things going on here. First of all, earned service revenue of $5,600. So everything that Dr. Luke did for the day came to a total of $5,600. So that $5,600 is service revenue, right? We have, and that's going to be revenue. And revenue is not one of our columns. But remember that retained earnings is increased by revenue, decreased by expenses, and decreased by dividends payable. So what we're going to see here is retained earnings goes up for the revenue, the $5,600. Now, so that's one part of this. The other flip side of this is, okay, we earned revenue. Did we get cash or what? It tells us we got half. We received cash for half of it. Okay, so cash is going to go up for half of the $5,600. So we're going to have $5,600, half of that, $2,800 is cash. And then the other part, you know, when you go to the doctor and they'll say, we'll bill you, that's going to be accounts receivable for this doctor. So we will see that we have retained earnings increasing by $5,600 for service revenue, and then we're increasing cash and increasing accounts receivable. Okay, February 16th then, with a business paid employee salaries of $2,300 for the first half of the month. Okay, so we paid employee salaries of $23 for the first half of the month. That's a transaction because there's a cash amount involved, there's a dollar amount involved, and we can measure it, $2,300. So what we're going to see here is we're paying out cash. So we have $2,300 cash going down, and then the other side of this is an expense, and we're going to call it salaries expense because we're paying for payroll, and an expense will reduce retained earnings. Retained earnings is increased by revenue, decreased by expenses, and decreased by declared dividends. Okay, a few more transactions, and then we're going to do some totals here. Okay, so February 25th, Dr. Luke treated patients and received $1,500 cash at the time of service. Okay, if we receive $1,500 at the time of service, we're going to be getting cash for $1,500 and earning service revenue. So we're going to have cash of $1,500, service revenue increases retained earnings, so that's why we're showing in that column. Next transaction, two more. The business paid office rent of $1,000. So what, that's a transaction. There's a dollar amount. We paid office rent. When you see the word paid, that's cash. Unless told otherwise, that's cash. So you see the word paid triggers cash. So we're going to have cash decreasing by $1,000, and we're also going to decrease retained earnings because that's an expense, rent expense. So we're going to reduce retained earnings, and we're going to reduce cash as well. Okay, and one last transaction, then we're going to drop some totals and talk about what we've discovered here. So the last transaction is the business paid $500 on account. Okay, paid $500 on account. What we're doing here, what does that mean? Well, paid means cash is going out the door. So we paid $500. The company paid $500. So cash is going to decrease. And when we pay it on account, what we're doing on account means it's either accounts payable or accounts receivable. Accounts payable are things we owe. This is accounts payable. So we're going to be reducing our liabilities. What we're doing here is we're paying $500 of what we owe. So we're going to have $500 decrease in cash and $500 decrease in our liabilities because we don't owe that now. We're sending out a payment on our account is what's happening. Now, we did this. This is not a formal form, but the question was asking what's the impact on the accounting equation of all these different activities. So what we're going to do is, through the magic of PowerPoint, I just totaled each of those columns. So what I did is I went through the cash column and I added every positive number, subtracted anything in brackets, and I got $45,500. So accounts receivable, we had $2,800, so that's the total there. Medical supplies, $1,700, so there wasn't anything to add in that column. So I'm just going across, adding and making the total. So I have a total for each of those accounts. And then what I'm doing even further at the bottom is I'm adding all my assets. So I'm adding the $45,500. I'm adding accounts receivable, I'm adding medical supplies, and I'm adding land. So I have all those combined, and that totals $155,000. So that's my total assets. Then I could add accounts payable and notes payable for my total liabilities, and then I could add common stock and retained earnings for stockholders' equity. So combined, $155,000. Okay, now, so we have a series of questions to asking, so I'm going back to this. And the first question at the top there is how much are total assets? Well, total assets are going to be the $155,000, adding my column of cash, accounts receivable, medical supplies, and land together. So that's $155,000. Next up, how much does the business expect to collect from patients? And the answer to that is going to be accounts receivable. Accounts receivable are the amounts owed to the business from its customers. So in this case, it's a doctor, from the patients, that's the $2,800. So that's why we keep track of these individually, because we can answer these questions, and these are big questions to answer. So how much does the business owe in total? Well, what the business owes in total are the liabilities combined. So your accounts payable and your notes payable. And how much of the business's assets does Luke really own? What's going to happen there is that's going to be stockholders' equity. When we talk about how much the investors really own, the investor is the doctor. The doctor is the investor. If this is a corporation, the doctor gave cash to the corporation and in return got stock and is a stockholder. So how much of the business does the doctor actually own? It's going to be the total of the stockholders' equity. And then how much net income or net loss did the business experience during its first month of operations? It's going to be $3,800 because that's the revenue minus the expenses of this first month, okay? Okay, so we're going to do one question. Okay, so the question that we'll have is, which of the following transactions will increase one asset and decrease another asset? Okay, so let's just talk through this. Which of the following transactions will increase one asset and decrease another asset? So we'll analyze each answer and see if they're both assets or not. So the purchase of office supplies. Okay, so office supplies is an asset. On account. On account means that we owe somebody something. That's going to be a liability. So A, fails. It cannot be the right answer because there's an asset and there's a liability. Answer B, the performance of services on account. If we perform services, we earn service revenue. That's an equity account, so B fails before we get any further. C, the purchase of equipment. Equipment is an asset, and we use cash. Okay, so it looks like C is the answer. But we'll just check D, the performance of services for cash. Perform service, that's revenue, which is an equity account, so D fails. So the answer is C. I'm going to close the question in about 10 seconds. And then we will be done with class. So I will see you on Wednesday. Make sure you've answered this question. It's being closed. So have a nice day, a nice Monday, and I'll see you on Wednesday. Okay, can you stop?